pay and hell. So as a tax consultant, what do I do? Will I add it back to will it be will that be constitute a tax deduction or so? Will
No,
it be
no,
allowed
no.
or disallowed?
It will be disallowed because it's only when it is, when it comes to exchange laws from translation, it's usually disallowed. It's actual tax is like now if the loss, if it's a loss today, tomorrow it can be a gain. So it's usually when it has crystallized, because most of the time tax would be on actual basis, and this brings us to deferred tax. So there's what we call deferred tax. You can put that in a deferred tax account and know when you adjust your changes in your deferred tax, then you make your payments of that changes in deferred tax to the tax authority. But ordinarily, on the face of it, exchange laws arising from translation of the USD account will be disallowed because it's not a
It's
real loss.
disallowed. Okay,
Yes.
okay. So if exchange loss is disallowed, what about exchange gain?
No, it's also deductible. The exchange gain will reduce your non-taxable income. So you are going to reduce it because it's not a realized.
Okay.
Yes, you are going to deduct it from when you are doing your adjustment of taxable income. Both exchange loss and exchange gain is treated the same way. So
So
you are going to less exchange gain from as a non-taxable income, and you add back
taxable.
exchange loss.
Okay. So um, would will the same or will similar treatment applies to when you have a loan? Perhaps you get a foreign loan for $1 million this year, and the rate is 430, or let's say 379. But next year the rate goes up, to be 400, for example. I'm not praying so though. But then if it goes to 400, what happens? How do you treat that? Is the same? Are you going to treat it the same way? Are you going to give it the same treatment? Because by the time you revalue the loan, it will be like an exchange loss kind of. So what happens to that? Do you give it the same treatment or similar treatment?
No, for instance, if there's a devaluation of that of the naira, you said, it means that you are paying. Have you paid based on the new exchange rate? Have you
Okay,
paid
so no.
interest, or you are just valuing it? Have you paid? Let's say you obtained the loan at a particular interest rate, let's say 380. Okay, and now the exchange rate is now 400. Have you suffered loss from the new? Have you made any interest payments at this particular new rate? Because most of the time, issues like this goes into deferred account, that deferred tax account, whereby it's not only exchange rate differences that go into the account. There are a lot of things that go into the account: inventory, fixed assets. A lot goes into the account, so you need to be able to manage that account separately. So in the case if you've not really suffered a loss, because the exchange rates can change, the next day and be favorable to you. So the expense, it could be an income or expense. It has not been realized. It has not been realized. So if you've made a payment of at the rate of 400, you suffered additional interest payments at the rate of 400 naira, which is the exchange rate additional, instead of at 380. Okay, then yeah, you can. It's a good case to claim that as is expense, because these are not within your control. It's the macroeconomic uh, situation that changed these rates, and you incurred interest payment at the new rates, and the interest payment is for the business to continue to operate as a going concern. You are earning income from the interest payment you made, so that could be a good case for you to claim it as a finance cost. part of your finance cost, and it will be accepted. But if it's not something that it has not really occurred, it's due to valuation issue, or it has changed, it can come down, it can go up. The taxman will not accept that. It will be written back.
Okay, so thank you so much. So at what point would you bring in deferred tax in your tax computation, or would you consider it? Like, for example, in the ABC Technologies Limited that you just cited, and you use that as a scenario here. So, at what point will you consider deferred tax?
Yes, when you do your current tax computation, then you need to do a separate computation for deferred tax. So this is a different schedule. So you would have done your deferred tax computation in a different Excel schedule, looking at, okay, let me look at my deferred tax. Uh, that there are some taxes that will come due to timing differences. Okay, like the exchange gain or the exchange loss that we talk about. There could be a gain that there could be a gain that there could be a gain that you know that will lead to a tax in the future because of as at today this gain has not been realized, but tomorrow if you make sales from this gain, then you are going to pay tax on it, so there will be a deferred tax liability. And there could be a loss that you feel that yes, as of today, we are making a loss, but tomorrow this particular loss can be um, reversed and recovered. So that could be a deferred tax asset. So you will look at the entire balance sheet from property, plant, and equipment to receivable to even your your cash balances, especially when you have financial instruments, financial assets, and like a dorm account as well, which is you have some amount denominated in a different currency that's exposed to exchange. So the deferred tax, there's a separate schedule for deferred tax computation that will let you know at the end of the year your new deferred tax liability. At the beginning of the year, you would have known that you would have been maintaining your deferred tax account separately the way you are maintaining this one. At the beginning of the year, there's a deferred tax liability. Now, if the deferred tax liability should increase, it means that, yeah, that you are to pay additional tax to the taxman. So, if the deferred tax liability at the beginning of the year was like 50 million, then the deferred tax liability at the end of the year increased to 52 million. Therefore, you have to pay additional 2 million to the tax authority. Okay, because when they come, they will look at your different tax accounts as well to see the differences or the movement in your different tax account. So that if this movement in different tax account have been has resulted to additional tax, the movement could be a positive to the company, whereby there's a different tax asset. Therefore, you can claim back from tax credits from the tax authority. You can explain to them that I've overpaid you, in the previous period. Looking at my deferred tax account, I have a deferred tax asset from you. You put down your case and they tell you, okay, use the deferred tax asset to reduce your CIT obligation that you're supposed to pay to us. So this is different from the schedule. Deferred tax accounting is different from current tax accounting. So that's a different schedule you're going to prepare. So if you have increase in deferred tax liability or a decrease in deferred tax, the difference will be paid to the tax authority. So it won't come directly in this schedule. It is a different schedule for deferred tax computation.
Okay, so thank you. But I want to know, in this case now, as a consultant, at what point will I consider looking at deferred tax? At what point? I mean, in this case, you haven't mentioned anything relating to this on this company account. But as a tax consultant, at what point will I consider it as something that needs to be done.
Yes. Okay. In this particular case, we are looking at APC technology. They don't have any deferred tax issue because they are not exposed to, for instance, foreign exchange transaction. They are not exposed to that, and again, they are not exposed to when it comes to the timing difference between uh, the carrying amount and the tax written down value. There's no significant difference in these two items. So at any point, you will consider deferred tax when you envisage that there will be a difference between the tax written down value of any elements. Okay, I'm still sharing. If there's a difference, I'll show you. You do your deferred tax, like open your financial position and look at any point in time that this is a very simple company. The PPE, if there's a difference in the carrying amount based on IFRS accounting in the PPE and the tax written down value, it could lead to a deferred tax asset or a deferred tax liability. And if that difference is a permanent difference, there's no deferred tax issue. If that difference is a temporary